Good morning to all. Normally, I deliver this conference in English, so you will have to excuse me, please, if I jump from English into Spanish. How many here know what blockchain is? And how many would be capable of explaining it? I see more and more raised hands every time I ask the question, but still there's few of them. Okay, I have two disclaimers, which I imagine you already read. Here's one, then there's the other. I did my job. It says that I'm going to use examples from many companies and not to invest in these companies just because I mentioned them, because I'm just here to tell you how to use the technology. I'm not advertising for them. We have a web page here that are devoted to tech, not necessarily Insurtech, because the definition of Insurtech can be restrictive. There are companies that work for other industries, or we might use in the area of insurance like RefTech or SureTech or XTech, etc. I began this company 5 years ago. I isolated concepts of which many of these companies talk, and there's 7 concepts that I want to leave with you here today. Many of them similar to what we heard from Slice. The first one is that people want to have an impact on the product and an impact in the world that surrounds them, with a hashtag, with a piece of data that is going to say I have less risk than another, and that's why I should be paying less. So there's a new paradigm of social interaction regarding the products we consume. The other notion is that that is why the product is personalized, it's customized, it adapts to my risk, to my lifestyle, to my car, to my home, etc. And that is why it is a product that I should be able to buy almost in real time, or that should adapt to me almost in real time. So being able to buy a product in 3 minutes because I'm traveling and I forgot, I just remember I'm about to get on the plane and I just remembered I didn't get my insurance. That is wonderful. The other notion is simplicity. You cannot sell a customized product with impact, where the data have an impact on the product, that it's immediate and that I can buy in 3 minutes, if it's not a simple product. And transparency in the process. I cannot have somebody reading a 200-page contract to sell a product this way. The other two notions or concepts that are key in the concept of blockchain are the part of self-sovereignty of the data, in the sense that I am responsible for my data. They should be 100% mine. I should determine how to use them and how they are used. And as mentioned by Ernest today, it's the trust and the confidence. All these insurtechs say that they are more reliable than traditional industry, and that we should be able to trust the product. Why am I saying all these things? Because blockchain has the ability to help in almost every one of these concepts. Today, I am going to focus on these three. Normally, this is what the world of insurance should be all about: to generate to understand a risk and to get a certain capital with a certain risk appetite to finance this risk. Today, blockchain is working on what Ernest just said a minute ago. Through automation and, among other things, blockchain platforms reduce that journey so that the path between the risk and the capital is more automated and direct. Sometimes it's so direct that you almost don't need an insurer for that. And that's the idea of the people who work in insurance blockchain. And if we look at the way that our products have evolved, in the first generation we had this type of product where where we took on more risk than we had to take on. Then it's been evolving through generations, where the consumer assumed more of these risks through options. And today it's this pillar where we interact with the consumer, and we have products that are like a partnership for life. I understand you, I know you, and therefore I'm selling you a product that is your product, and I want you to see me as an ally, as a strategic partner, and not as a strategy that sells you an insurance. And this is what we have here. And in part, that is what Ernest was saying in his slide presentation. If we have an insurance product that has the ability of connecting to data almost in real time, with hypergranularity in those data, and a product that adapts in terms of coverage and price to those data that are coming in almost real time, we will have the ability to have a product that responds individually to the risk of an individual or a company. And it is what we call fourth generation solutions. And people think that in the future it's going to be this type of products that is going to make it in the world. Now, what do we need for this? It's key to have data. And when we look at data in the area of blockchain, people live on the movement of cyber bonds in the 80s and the 90s, and the data are key. Now, where do these data come from? Where does it get stored? How is it protected? Protected from what? Who owns the data? Who or what can access it, and for what? It may be a company, a person, a program, a platform, whatever. They are generating the activity of blockchain in the area of insurance. Now, let's see how this behaves in terms of the activity we're seeing. Since normally my audiences are very heterogeneous, I'm going to take 5 minutes to explain what blockchain is actually. And and I apologize to Mike because he's heard it 1,000 times. But this is an explanation I generated for my children when they wanted to know what their mom actually did in life. Well, this is the definition, the traditional definition. It is a shared distributed ledger technology. And I'm going to explain what all this means with three things: with Legos, which is something that my son actually loves, where you can generate a ledger. I use Harry Potter normally, but because of copyright issues, I've got a book that doesn't have Harry Potter in front, and the expansion of rumors. This will help us understand why this technology is different and why. Why is it different from other technologies? Because sharing a ledger is nothing special. There's other technologies that share data records. So, why Legos? Well, when we build a Lego construction, there's two things. The first thing is that it is very difficult to change one of these bricks underneath. Uh, they're already glued together. It's very difficult to move one of them. So that is why it's so important to agree what color this brick is going to be like and what size, because changing them after it's done is almost impossible. So I'm going to do it in a conversation determining how I want to build this tower. This is a tower that was built in Hungary some years ago to win the record of the tallest tower in the world. And I don't think there was a mother involved in the generation of this tower, because it's impossible. 1,000 people getting together to build a tower like this. How can they come to an agreement as to the color of each brick? This is exactly what blockchain does with blocks of information. It gets thousands of people to come to an agreement in almost real time on what the next brick is going to be and what information it is going to have inside, without knowing each other, having conflicts of interest, and communicated through a network that is normally anonymous. So blockchain actually generates a solution to that problem using consensus mechanisms, of which there are several, and it gets thousands of people who don't know each other and who may even have conflicts of interest to get together and to come to an agreement as to the color of these bricks. Now, my daughter doesn't like the bricks, but she likes to read, and she loves Harry Potter. So the fans, Harry Potter fans, they want another Harry Potter book. So I told my daughter, imagine that all these people managed to write the eighth book of Harry Potter, page by page, among all of them. coming to an agreement in real time, and they know what should be written on that page. What does this analogy have to do with the tower? Books normally are sequential. What happens in the first page is going to affect what happens in the following pages. The same happens in blockchain. Each block is related to the next block, and it's a cryptographic fingerprint. I write this page of the book, we come to an agreement, and we encrypt it, and we generate a print, a mathematical, a cryptographic print that we are going to place in the next page. In the next page, we write new stuff, and that becomes a cryptographic fingerprint also. And if I want to change a page, it's very difficult because we would have to redo all those digital signatures from going from one page to another, and would generate that block, that chain of blocks. That is what gives it its name. I could do that in the cloud. I could have a book like this in the cloud, and I could have people doing that in the cloud. It's not the case of blockchain. In blockchain, this book is not in the cloud, because if there were a single book in the cloud and somebody wanted to change it, they probably would be able to do it, even if they had to redo all those prints. Now, the book is distributed. What does it mean that it's distributed? It means that in real time, everybody has a book with a new page of the book, and the page of the book is propagated through algorithms that are based on the idea of rumor propagation. We come to an agreement about the following block, and that block is propagated through the network. And through mathematical mechanisms, you determine what the next block is. Because, I mean, you could propagate it in two different blocks at the same time. And if everybody agrees that the next version of the book is the one that has block A, that is the one that is used. So that's not a book that I copy and send to others. It's something that is self-synchronized throughout the entire network of users when the book is generated. What does that mean, actually? That when we have a record that people agree to in transactions, that at the beginning it was about cryptocurrency, but now they are added to this chronological record, and everybody agrees that whatever the record contains, that is the truth. At the beginning, it was like an accounting record before it was a Bitcoin. Now it talks about other records. So the way to maintain this is not magical. Here I used to have an icon of Snow White and the Seven Dwarfs, but not everybody knows that those dwarfs were miners. So I decided to put this icon, which was clearer. Who does this? It's data mining. It's done by miners. The miners, they have an economic incentive to validate that new block. And how is it generated? Because if I don't control the ability of the miners to talk amongst themselves and come to an agreement about something that is not true and corrupt the book or put in assets that they don't have, I need to distribute this anonymity. And I do it like if it was a contest. And these people have to solve a problem, and the first one who solves it is the one who takes the award, who wins the prize. Now, the first one who solves it is followed by others who also solved it, and I see that there's a validation because all these people don't know each other, and yet they validated something that wasn't correct. They came to an agreement. The simplest way to do it is to think of it in terms of trying to guess the combination of a lock. And normally, if you forget your combination to a lock, for example, at the gym locker, you can simply begin to guess with 0 and go up and up and up until you finally find the combination. Here, it can be 60 combinations. You run an algorithm, and the fastest one in finding the algorithm can show that the validated. It's much more technical than this. I'm oversimplifying, but that's what the miners do. This is a way for this record to be maintained without any it is maintained on a distributed basis. Okay. Once we have that, we have the following stack. The following stack is that, well, now I have a database, and in that database, at the beginning, I had transactions that told me who was the owner of what. In 2013, the person realized that actually we can use that database not only to have transactions and for them to be unchangeable in their records, but to put in programs to execute things. And once you put them in that unchangeable and distributable database, nobody can change the way that they are executed. That is what is fantastic about this. These are not contracts. These are not intelligent. They're not even new, because the first time they were conceived was in 1996. But for the first time in history, we can have those smart programs that automate things as the ones that you may have in your servers using a parametric insurance program. But instead of being in your server, they are in a place, in a record that nobody can corrupt. And why is this interesting? Well, because if I have a contractual relationship between two parties who have a conflict of interest, I, for the first time, can now automate a relationship between two parties in a place without there being a third party taking care of the uncorruptibility of that record. If we come to an agreement about something, I have incentives to modify that automated version, and the other party does too. Now, we are not going to come to an agreement about the server where we're going to automate the process. What we're going to do is put it in the server of a third party who takes care of safeguarding it so that nothing happens to it in a place where nobody is in charge of it, but where nobody can corrupt it. That is why the smart contracts became so much in vogue, because the idea was to automate the relationship between or among third parties with conflicts of interest amongst them. So this is a system that transacts value in a decentralized way. And the concept is not all that new. When we send something centralized or not centralized, three things concern us. First, safe and secure transfer. When you send a mail, most people don't worry about whether that mail is going to reach the right person. You send it, and the person gets it. That's it. But that was not always that way. There were people who were worried about centralization. They were worried about the other person getting the mail. The other thing we have to do is ensure that if I have a record, that I should have a record about the transfer of the value, so that there's no duplication, so that it doesn't transfer twice or three times or whatever. The other one is to guarantee the legitimacy of the transfer. Buyer and seller must have ownership of transacted assets, of the transacted assets used to buy them. Now, this is a system that uses this type of validation, and we can do it for the first time on a decentralized basis, where a network of peers, a peer-to-peer network, you can transact values without anybody being in charge of knowing how it works. And these things should be automated. And so at the beginning, this was used with cryptocurrency without money. But what happens if we could do this with risks, and the native ecosystem of blockchain is trying to do it without money? Now, these are the 6 areas where we see blockchain activity in the risk area. Normally, you can imagine as if it was a timeline. The first one would be the short term, middle, the medium term, and in the long term, which would happen in 10 years, thing is to the right of the slide, and I'm going to give you 2 examples of each. The first thing we see in that first pillar is synchronization and automation. The idea of having this record of automating relationships among third parties can be done through a peer-to-peer network, but the truth is that it can only be applied to a network of companies or in value chains. So many applications that we see that come from B3E or through B3I, those kinds of networks, what they can do is use this idea, this notion that we can organize the relationship with the market amongst companies through blockchain without having people to centralize many of these transactions. So this can be used in the stock exchange. It can be used to generate securities and put it in distributed markets. It can be used to generate secondary markets of life insurance. It can be used to generate platforms where you auction annuities, for example. or do it like or work for to cover catastrophic risk after a hurricane or a natural disaster, an act of God. But the idea is to standardize and organize the relationships among the insurance industry with all its shades and all its interacting parties. This is a very clear example. If we, for example, look at the double insurance fraud, it's very difficult to share information because I don't want to share the information of the losses I am for which I get claims. So an idea of how to use a distributed database among peers is, for example, this. In the example, this example is for car insurance, and if I take the identification of a person, in this case, the ID, the passport, whatever kind of ID the person uses, and the vehicle ID number, what you do is use the cash-in concept to generate something like that string of numbers and letters that you see to the right. And when somebody says, hey, if I'm presenting a claim here, I don't say it was such and such with such a car, etc. No, what I do is I key in that figure that you see to the right. So if this person goes to a second company to claim again for that loss, the second entity might say, no, gentlemen, look, sir, your vehicle and your passport have already been registered as somebody who had an accident in these past days. It's a way of sharing information without the true nature and amount of information, the name of the client and the vehicle, everything being shared. The other thing we can do is automate the execution of an insurance. In the parametric notion, it's very easy. I can automate a parametric record very easily for travel, for agro purposes, whatever, and I don't need to automate them. But in some cases, it does make sense to automate something outside of the servers. The one example we did was the balance. The saldo, for example, used to sell an insurance for people outside the United States. Outside in the United States, people were convinced that if they died, people would not, their relatives would not be able to go to the insurance company and claim the life insurance. So this generated value only for this market, and it was sold as a product that could not be paid, and that it was executable, and nobody, not even the insurance company, could stop it. Now, there are similar examples, and this goes in line with what we heard from Ernst today, of having things connected to generate that. So the same way that a parametric could communicate or could be related to a car, we could do exactly for the same for another car, and you could pay a claim, for example. The selective data sharing, this is an example of a parametric that you can place in the blockchain instead of doing it parametrically. In that second pillar, in the medium term, we have two types of things. One is the solutions of traceability, the identity, and that is being generated as part of the infrastructure of the blockchain, because if I have a place where I can put up information that nobody can corrupt, then once I validate the information, what comes out from outside of the blockchain, I could input the ownership of a car or the copyright of an author or the ownership of an apartment. And I could also see how goods are moved throughout the economy. So the conditions of traceability are services that what they do is use this record to know exactly where it comes from, for ecological vegetables, for medication, to avoid fake drugs, for example, and everything that has to do with copyright. If I can do it with a Bitcoin and I can do it with goods, I can also do it with this type of thing. where besides knowing where something was, since I know where it was, I know who the owner is, I don't need to a notary office to look at the owner's record. No, it's a virtual wallet that has my ownership data. And if I can do it with virtual, digital, and physical goods, why can't I do it with people? So there's companies that are working in a virtual vaults of attitudinal and transactional data where I let my Fitbit communicate with my digital wallet or ID to communicate to the vault, to tell the vault whether I walk or I don't, how I drive, and what I eat or don't eat when I get up. So it's a transparency of data that we have today that today go to centralized databases that sell this information. In our lives, we can be the custodians of our own data because they are in a place where nobody, not even us, can corrupt them. So this is the idea. It leads to the fact that in the future we are going to be able to have products that respond in almost real time to hyper granular data. Because those data, maybe we're not going to be afraid of generating them and record them and generating that digital identity because we are going to be responsible for those data. They're not going to be in Facebook and Google or in Amazon. We are going to be responsible for our own data, and nobody, not even us, can corrupt them. And that is the concept that I was explaining at the beginning of the self-sovereignty of the data. Now, virtual vaults or wallets with my DNA, where I have my medical records or the drugs I consume, my medication. If I'm sick and I'm a diabetic and I need to record my insulin data, instead of sending them to my doctor, they are going to be there in this portable solution that I can carry with myself from one hospital to another, from one insurance company to another. The other thing is saying, hey, there's many data that we don't have. What happens with people? What do we do with people for whom we don't have data? Well, actually, there's a lot of information about those people who recorded, who registered 15 years ago. But you can generate betting markets, for example, to generate that price in the same way that they are generated in Wall Street stock exchange organizations. So there are people who work in what we call prediction markets, and that's where people bet on the value of something. Vouch for me does it, for example, in the case of cars. If I know that my son is a good driver, I can bet on his not having a crash. If he has a crash, I will pay the deductible, for example. I can bet on things based on the corporate capital that allow me to insure more people. And I can combine all these things into solutions that are actually in nature, which is what Sovereign is working on right now. That is where it is aimed at, portable ID solutions. How does the rest of the ecosystem see this? It sees it the following way. If I have virtual vaults that have my data, but they can also have the data on my car, whether it was given maintenance or not, how many people drove it, how did they drive it. So each asset, an apartment, the inspections it had, who with what type of material, each good and or each asset or in each person can be, their data can be kept in that vault, and it is totally uncorruptible. So I can have smart contracts that read all these solutions and generate a risk and give it a price and do a pool of different risks, generate as if it was a security that they can later offer in a distributed market. So it's a P2P insurance. It's really very important because I can have smart contracts that work as an insurance company, and they connect the peers throughout those networks to generate a certain risk level. And in the western part of the world, for example, we have this, and in China at this point we have 25 examples of peer-to-peer insurance where there is a self-mutualized mutualization of the risk through networks that are programmed and they have no specific insurance company behind them. But how do you regulate a company that doesn't exist?
So the new data generation, I already mentioned that. And this last example, in my opinion, is very interesting because it is available in the market. This is the first program mutual of the world. It was generated in the UK. It is registered as a cooperative in UK where members are generated through this blockchain network and they generate intelligent contracts. Since we don't have historical data of how much is the cost of an intelligent contract, the programmer bets on the good or bad of an intelligent contract. So with that, they generate the price. This is the first example that considered the complete value chain and generated a product that is programmed 100%. It's in the UK and it's called Nexus Mutual. So where is this leading us to? Well, long-term risks, for instance, longevity, and we have pension funds which are programmed where there are people apparently that is technology, that trust technology, and they use that, and that exists. So all of these models, what do they generate? Well, they generate autonomous mutualization platforms. The idea is that you can automate a lot of risks, including the live area, which are very complicated. This is being done for the agribusiness, for travels, for hurricanes in Puerto Rico. There are many areas where these platforms are already available. And this is the idea, this is the nirvana of the people working in this area. In the future, there will be a self-mutualization of risk that is decentralized and doesn't need an insurer. This won't happen tomorrow, but with oracles and data sources, for instance, from Internet of Things, social capital, or predictive markets that generate data where we don't have historical data, we can automate using intelligent contracts apart from for risk mutualization. And at this point, there is a lot of experimenting. Nothing to worry about, but there is a lot of experimenting in this type of cases. So the final result is that in principle, we are facing a technology that has a huge transformation power. I love technologies, and that's why I work in Wall Street, because I am very bullish with technology. However, it is exempt from a lot of things that have to be improved upon. There are many technical challenges, but also regulatory challenges and industrial challenges, sustainability, etc. As we also have that in artificial intelligence and big data strategies with the amount of data we are generating every day. So these high stake technologies create a lot of problems that we have to control somehow. But the blockchain ecosystem, thanks to capitalization of many of these crypto coins, is capitalized to do this and believes in ideologically in this world where the bank is not needed, the insurer is not needed, a credit house is not required, central banks or governments are no longer required. So they are investing in that. And we don't see it because that's not part of the things we are constantly monitoring. But the infrastructure is being built today, and there are many experiments using it. I believe that in the life and health area, this could radically change the way we develop insurance and monitor risks. This is much more important than in other areas, in the non-live area. The only way to survive is to have a data strategy that helps us to understand who has the data, who will have the data in the future. Will we have the data available? Are we going to buy data from the consumer? How should we incentivize consumers? What happens if there is no regulation? So two things are important when you think about blockchain. Number one, not everything is logical just with blockchain. Blockchain is useless for some things. There are better technologies for that. So where is blockchain applicable? Not in areas of efficiency and automation. If you can do it internally, you don't need it. But in areas where we need a new paradigm of governance of an ecosystem, because that's what blockchain does. So we have to use areas in which today we have problems we cannot solve. And the idea of what makes blockchain useful is decentralization. So you have to ask yourself, where does decentralization add value? Because not in every process or risks they be logical or make sense. So this is the core idea. Blockchain is not a technology. It's a sociological innovation which allows for markets to be self-regulated, and people that don't know each other and have conflicts of interest can do value transactions without anybody taking care of regulating the market or the network they use. So anything we build must keep that in mind, because the origin of blockchain is a very anarchical origin. It is against the status quo. So anything we build with chain must keep and ask, what's the benefit of decentralization and what type of risks are logical in this self-mutualized platform? Where does it add value to have something decentralized and automatized? So thank you very much, and I don't know whether we have any questions.